Hello and welcome back to the Costing and Pricing Learning Program. My name's David Gilchrist and I am presenting Webinar 8, Managing the Target Price Gap. Before I do that, just the standard reminders in relation to copyright. Remembering these materials are provided in an open access format, so you're able to use these materials commercially or otherwise, but you must adhere to the copyright requirements, and I would request that you would refresh yourself in relation to those. They're available both in the study guide and also in the Webinar 1, the first webinar for this series. The navigation for this webinar, the previous webinar was Webinar 7 where we looked at costing and pricing under the NDIS. This webinar, of course, looks at managing the target price gap, and the next webinar, Webinar 9, looks at solvency and sustainability. Remembering also that throughout the webinar slides there are navigation markers which are designed to help you to navigate from the webinar into the appropriate parts of the study guide and the National Costing and Pricing Framework. Remember also that webinars are designed to be short, snappy looks at particular topics and to give you a bit of a taste of that topic so that you can then explore the more substantial elements of materials within the Costing and Pricing Learning Program. So make sure you avail yourself of all of those materials. In this webinar, we're looking at the target price gap, which we've introduced a number of times in previous webinars and which are really the focus of a number of the materials within the Costing and Pricing Learning Program. Specifically today, though, we will have a look at scenario analysis and how you might use ABC costing to assist you in terms of understanding better that gap. We will look at service mix adjustment, and service mix, of course, was introduced in Webinar 6, and also have some discussions around the ideas associated with boosting efficiency, particularly in terms of service cost and controlling service volume. Anyone who's seen previous webinars or has participated in seminars would have seen this slide before, and in many respects this slide is the central slide for the Costing and Pricing Learning Program. The target price gap is absolutely essential to be calculated by any organisation that is trying to understand how financial sustainability applies in the context of any funding environment. As you know from the previous webinar where we looked at the NDIS was certainly the catalyst for the development of the Costing and Pricing Learning Program, but it is actually financial sustainability in the broader sense that is the central focus of the program and the central focus of ABC costing. Therefore, the target price gap is really fundamentally the essence of ensuring financial sustainability going forward in any sort of person-centred, individualised funding environment, of which the NDIS, of course, is a substantial element. The target price is the price we require in order to ensure sustainability. It's the result of our costing and pricing process, and in short, it includes both cost recovery but also a profit. Now, I'll talk about profit in the next webinar in relation to sustainability, but the short answer here is that profit is not a dirty word, and you must achieve a profitable outcome ultimately to maintain financial sustainability, because it's that profit that builds the balance sheet, and it's the balance sheet that provides for the replacement of all of your assets and other materials. It also provides for the capital needed to undertake change management and to introduce innovation, all of which costs money. On the other hand, the achieved price, the price actually provided by the funder, is the amount actually offered by any funder. So in this example, we've said the price offered by NDIA for services rendered. So in other words, the target price is the internal calculated desired price. The achieved price is what's actually being paid to you, and of course the gap is the difference between these two. The target price gap constitutes that territory, if you like, over which you can strategize in terms of financial sustainability. It's that gap that's got to be closed to ensure ongoing short, medium and long-term sustainability for your organisation. The difference between the target price and the achieved price, or that target price gap, needs to be calculated for each individual service, but it is at the aggregate of services and activity levels that it really comes into play. Each individual service needs to be priced in order to be able to determine its individual gap, and so that you can see which services provide profit to the organisation and which don't. But at the aggregate level, it's the combination of those prices by the activity levels for each service that allow us to understand whether we are truly financially sustainable or not. If the target price gap is positive, this is a very good thing for the organisation, but it might also mean that you should go back and recheck your calculations, because the systematic underfunding of human services in Australia means that this result is fairly unlikely, particularly because the target price includes a profit margin as well as cost of capital, which traditionally is not costed by government funders in disability services, or indeed more broadly. If the target price gap is negative, and for the reasons I've just mentioned it is most likely to be, then you need to examine the impact of this on your organisation and determine the best way to remedy it. So always looking to reduce that target price gap. If the gap is caused because you're not paid enough to cover your margin, this will have a medium-term impact on sustainability. So while you can operate for a short to medium term on a negative target price gap, the reality is the medium to longer term will be a significant financial challenge for your organisation, because you won't have built the balance sheet that results from achieving a profit. If the gap is caused because your organisation is not paid enough to cover things like the margin and depreciation, then that longer term sustainability is a real issue. However, if the gap is very large and doesn't recover those costs that you are paying out each day to operate your services, then that is a significant issue, because that implies that your immediate sustainability is in question. And of course that means that you need to respond to that very quickly to ensure that the organisation is financially sustainable, and particularly from the director's point of view, but more broadly, that you're not trading insolvently, because of course that has significant implications as well. So one of the areas that is really important to consider is that of service mix. And I'll talk about that a little bit more in webinar 6, as I mentioned before, but also the service mix at the aggregate level is what tells us the extent to which we are financially sustainable or not. One of the things that I like to say in relation to the target price gap is that it's not about discontinuing mission-centric services just because they're not financially viable, but it's about intellectually understanding the impact that those services have on your organisation from a financial perspective, and making, if you like, an intellectual decision at board and executive level to continue to undertake those services in the knowledge that other services you provide ensure your financial sustainability. In other words, we are not saying that only profitable services should be pursued. Rather, we're saying that mission-centric services should be pursued in the interests of your clients, but in a controlled way, such that you understand precisely what the impact is going to be on your organisation from financial sustainability perspective. This particular chart shows the target price gap for each unit of measurement. Remember, the unit of measurement, or UOM, is that discrete service that we cost and price to, provided by NCG. NCG is the organisation featured in the macro case study contained within the study guide to this material. As you can see, each UOM results in a negative target price gap. Once each UOM is analysed, it might be found that some products are of more concern than others, and that they have more negative impact on ongoing financial sustainability. Therefore, not only is it a case of closing the individual gap, if that can be achieved, but also changing the quantity of those particular services to ensure at the aggregate level you have at least a break-even price gap or better. In other words, your price gap should be zero, or it should be positive at the aggregate level. When we look at this service mix or look at the price gap, there are a number of ways we can start to approach our strategy around reducing the size of that price gap. The first strategy that we're looking at here is scenario analysis. With scenario analysis, we use our costing and pricing model, and remember there is, for small and medium organisations, a model available on the Costing and Pricing Learning Program website, which is an Excel-based model designed to support organisations in undertaking their costing and pricing in this arrangement, and there's also a user manual to that model available on the website. But remembering, though, that when we look at scenario analysis, there are two aspects to that process. The first aspect is that we might adjust our service mix. In other words, keeping all of our assumptions the same in relation to costs, and adjust the types of services that we deliver, as well as the mix of those services, to see what the outcome might be from a aggregate level target price gap perspective. And again, this was dealt with in webinar 6, so it's worth going back to that webinar to explore that idea a little bit more. The other idea is that, of course, you reanalyze the inputs of the model and look at how you might either reallocate costs. In other words, you might have got some of your allocation assumptions wrong, or some of your processes wrong in arriving at that particular allocation, or in looking at what elements of cost within each service element, UOM, you can actually cut, remove, reduce, depending on service quality and the mission of your organisation. And this is a really important aspect. At some point in this analysis, there is a line to be drawn in the sand in relation to a reduction in quality or quantity of service which your organisation will not go beyond. Quality particularly is important, of course, because there are human services risks associated with poor quality services, but typically if we look to reduce costs, then those costs associated with numbers of services delivered or the quality of those services. There are essentially two levers that can be pulled in that sense. So therefore, this is a really important aspect to appreciate, that when you're looking at scenario analysis and looking at how you might adjust costs, or how you might adjust numbers of quantum of services, or the quality of services, in one sense it's a movement of deck chairs to try and get the balance. At some point, though, that movement becomes too extreme for your organisation's taste for risks, or is not in the interest of the service recipients, and therefore ultimately it might be better to remove your organisation from the provision of certain services for which that target price gap is far too much, and which is impacting the financial sustainability of your organisation in the short, medium or longer term. Importantly, when you look at these costs, you need to look at all of the inputs into the model in terms of the cost expectations that you have. And you can undertake scenario analysis iteratively, so that is time and time again throughout the year. And of course, as you come to understand what your actual expenses and your actual activity levels are, you can start to repopulate your model for costing and pricing using actual expenditure, which gives you a more accurate appreciation of what the true target price gap is. Remembering, though, you must be consistent, you must be prepared to undertake this iteratively. That is, you must be prepared to do this over and over again in order to refine your costing and pricing, and to have confidence in the target price gap that you are trying to strategize around. And you can also use scenario analysis to undertake experiments in terms of removing particular services to see what the financial sustainability outcome might be in relation to those, and also in terms of adjusting that service mix accordingly. Remembering, though, it's the aggregate level that must be positive at the end of the day. Your mission-centric services that might result in a significant target price gap can be pursued, but they must be pursued in the context of an overall financial sustainability at that aggregate level. So scenario analysis, just repeating, is about using your model to explore different ideas and to explore areas where costs might be reduced in order to achieve a better aggregate target price gap outcome. The next element that I want to look at is the service mix, and I've already introduced some comments around service mix, but I want to talk more about the adjustment of service mix at this point, and look at the idea of the aggregate service mix, which is really important. The proportion, as I've mentioned a number of times in this webinar, of those services delivering a positive target price gap must outweigh the proportion of those not delivering a positive target price gap in order to ensure medium and longer term sustainability for your organisation. That means at the end of the day you need to understand what your services are and how those services aggregate a target price gap for your whole organisation. You can look at ideas and experiment using that scenario analysis idea that I've just been talking about, where you might look at emphasising different services more than you might have in terms of your service mix at the moment. You might also explore the idea of increasing your numbers of clients in particular services, so perhaps not changing the service mix itself determinately, that is changing the number of services and the types of services you provide, but actually adding more clients to particular services in order to increase financial sustainability. Adjusting the service mix is only the process of changing the services to actually be delivered to clients in terms of numbers and service types. So if you have a set of services that you traditionally deliver that are mission-centric and that result traditionally in a very poor target price gap outcome, that is negative, then it might be that you emphasise in your strategizing the idea of increasing those service lines that return a much more positive result to your organisation. So in other words, not changing the expectations of those people receiving mission-centric services, but actually building on those more profitable lines so that you can pay for those. Finally, I guess in relation to this, you need to remember that care needs to be taken to ensure that service mix is looked at very, very carefully, particularly where you are increasing the amount of service you're providing by increasing clients or iterations of service, that is number of services. Then you need to be very, very careful to ensure that you don't move outside of your relevant range. We talked about relevant range in the first 3 webinars because relevant range actually is the area where the assumptions you make in your costing and pricing exercise remain true. If you go beyond your relevant range, then it's very likely that you're either over-exercising the organisation, that is the organisation is working beyond its capacity, or you have to incur more costs in order to continue to operate in that way. Therefore, in adjusting your service mix and looking to close or reduce that aggregate target price gap as a result of adjusting the number of services or the number of activities for each service that you might undertake, will have some significant issues in terms of the relevant range and your overall costs or stress on the organisation in time going forward. I guess the other point to emphasise at this point is that this is not about reducing mission-centric elements of your organisation or those activities, but really approaching those activities in a much more intellectually engaged way so that you understand what the financial impacts are and you can mitigate, you can respond to those financial impacts to ensure ongoing financial sustainability for your organisation. Of course, the other element and the final element I want to talk to today is that of efficiency. And there's no doubt in the broader disability services sector, indeed in broader human services and across most services in the public sphere in Australia, efficiency is a word that is often used because there is an increasing cost for service delivery and we need to really address that. If you like, the efficiency side is the other side or the other strategy that can be approached in your organisation to reduce that target price gap. So service mix is one element, scenario analysis is a second element, the third element is boosting efficiency, actually attacking costs or attacking ways you do things to make it less costly. Managing the quality to efficiency balance can also be very difficult for your organisation, and remembering that at some point there is a point where you would draw the line and say, actually, we can't continue to provide particular services because we're concerned that the quality is affected too dramatically by the target price gap that we're trying to manage, or indeed that there's risk to clients and staff as a result of reducing costs to that extent. However, efficiencies not only relate to reducing the actual cost of inputs, but it might also relate to reducing the costs of overheads and doing things in a slightly different way that allow you and your organisation to achieve outcomes in a much faster, much more efficient way. In that context, I guess it's important to remember too that essentially cost management consists of making many detailed changes to the services being delivered and trying to reduce costs by either excising those costs, removing them from the build-up of a particular service, or trying to change the relationship of those costs to the particular service. It's quite difficult to demonstrate on a webinar of only 20 to 30 minutes, so it is important that you go back to the study guide and really look at this efficiency idea and explore that a little bit more in the context of your organisation. There are a couple of things, though, to think about in relation to efficiency. It is often important to deal with some of the elements that are not priced as part of, say, an NDIS individually funded type service. For instance, the taking on of a client typically is an expensive process, and dealing with clients or prospective clients, or even what we might term as tire kickers, people that are coming to your organisation looking to understand exactly what you do, whether you can provide a service, etc. It is important to efficiently be able to either recruit those clients into your organisation or to move those clients onto another appropriate organisation as quickly as possible. Secondly, it's important to think about those on-costs associated with client service delivery. So how do you, for instance, decide what a client service is and how that client service might be described and provided, what the components of that client service might be, and how they map back to things like the NDIS price list. The other things to look at from a cost management perspective include looking at overhead costs, such as head office costs. Boosting the efficiency, the cost management aspect, as I mentioned before, really should relate to the 80-20 rule. We should look to try and adjust and amend those costs, reduce those costs that are going to have 80% of the impact on the organisation's aggregate target price gap. The largest source of direct costs is normally overhead, as I said before, and things like head office costs are particularly important to realise, are significant. Increasing your activity levels within your relevant range, that is within the range of activity levels, that means you don't need to increase your overhead costs, means that you're able to leverage those costs much better and to be able to reduce the per unit cost for your target price gap. Many changes can be simple, quick and cheap, but a lot of changes also take quite a bit of money, and therefore being able to undertake large-scale cost management normally requires understanding of the relevant range, and I'll get to that in a second, but it also requires us to understand the context of cost management needs both staff and financial involvement. So not only do you need to think about what costs that you want to reduce, but you also need to have staff involved in identifying those costs, analysing those costs, and particularly the impact. One thing that successful organisations seem to be doing in that context is actually not only having, say, head office accountants and other support staff identifying and developing opportunities for cost management, they also test that, if you like, enculturating that within staff that actually provide care services to make sure that the cost management identified is actually going to be able to be implemented within the organisation at the coalface. Therefore, that's a really important aspect as well, the communication and the involvement of staff at all levels in the cost management process. I guess the other aspect of involving staff that's important to consider is the fact that the staff can provide you with opportunities for cost management, and often people at the coalface, the care staff, are able to identify inefficiencies and ineffective activities and operations that you might undertake, which will also help you to reduce costs. Therefore, the communication is important, and being able to reinforce to staff the importance of identifying efficiencies is critical to ongoing sustainability. The relevant range in assessing activity volumes is an important element, and I've already touched on this quite a bit as we've gone through this webinar, and it is dealt with in more detail in the study guide as well. However, just I guess reinforcing the fact that the effect of incremental service increases is often tempting, but additional service delivery opportunities also have additional costs associated with them. If those costs can be contained within your relevant range, then you will be able to leverage, you will be able to, if you like, reduce the per unit of service delivery cost of overheads. However, if you go outside of that relevant range, you will have impacts on the stress of your organisation and its long-term capacity, as well as potential impacts where you need to start to talk about the idea of having more staff involved in your organisation. Additionally, providing unfunded services will make it, of course, harder for disability services providers to remain within their relevant range. That is, when you undertake your mission services, not only do you want to make sure that you have at the aggregate level that financial sustainability, but you also want to make sure that those mission-centred services don't inadvertently push you outside of your relevant range, and that's a really important idea. Okay, the other element that is increasingly important within human services in Australia and is considerably spoken about is the idea of collaboration and the building of collaboration options for your organisation. Now, collaboration occurs on a spectrum, anything from one end extreme, which is a merger, through to other end of the spectrum where you have just very loose commitments and loose relationships with other organisations. Those collaboration options can be very, very effective in controlling costs, particularly where A, you're able to efficiently deal with those tire kickers, those people that are asking for services or not sure what they're doing, and you can, if you like, direct them to service providers more appropriate to their needs, that you have confidence in being able to provide a strong service for. And also the collaboration options allow you to have closer links with organisations that perhaps might allow you to stick to the knitting. In other words, some services you provide, you'll be much more expert, much more efficient, much more effective at providing those services as compared to others, particularly the peripheral services that might be required by some of your clients, but perhaps not all of them, or some clients that have specific needs that it is inefficient and ineffective for your organisation to provide. Where you have collaborations with other organisations, you can set up MOUs, so Memoranda of Understanding, or other methods to create both channels for clients to move from one service provider to the other seamlessly and efficiently, but also to ensure that you're not going to lose that client and that you can trust the quality of the service being provided by that other collaborator. There are, of course, other possibilities to explore, and they include collaboration for frontline services, so service delivery. More commonly, organisations are looking at sharing back office services, of course, so things like your head office services such as accounting, payroll, IT, etc., and sharing of staff in that way. The common pitfalls in relation to these types of collaboration options include a lack of planning, poor documentation, often a culture clash, but most importantly, a poor execution. Most mergers fail in the commercial world, not because they were bad ideas, but because they were executed poorly. And you need to consider in these collaboration ideas whether or not your organisation has the technical skills to be able to develop a collaboration option that's going to work, or the financial capacity to be able to implement that collaboration. So it costs money and time and needs significant skills to be able to undertake a collaborative process, and you need to ensure you have those before you work through your planning process and undertake what we call due diligence. And due diligence is, of course, that process that's used to be able to help you to understand how the organisation that you're targeting operates and whether or not there are going to be things like organisational culture clashes, operational issues that are associated with the way they might do business or the way you might, any financial issues, legal issues, or even service delivery risks that might be very important. The other thing that I think is important to highlight is that organisations seeking collaborations also need to undertake a self-due diligence, and that self-due diligence helps them to confirm that the collaboration is the way to go, but it includes things like really understanding what it is that you do as an organisation, not in terms of what funders might think you do or how your funding agreements operate, but actually what it is that your organisation is particularly good and efficient at delivering, and what does its mission want it to do. Self-due diligence also involves you understanding your culture better so that you can appreciate better whether or not your culture will clash with other organisations. So when we talk about cost management, and particularly the larger opportunities for decreasing costs over your services, things like collaboration opportunities and also back office opportunities are really significant. But remember, innovation, change costs, and it also requires a very strong communications program to make sure that you're bringing along all of your staff in relation to your collaborative ideas or your change and innovation ideas. Remembering too, as I mentioned before, it's worth emphasising, I think, that when we talk about efficiency and effectiveness, it is best to include those staff that actually provide services, because they have a strong appreciation of the proper flow of work, how things work, and also they have identified previously, I'm sure, those kinds of inefficiencies that might not be apparent to people in head offices. That's it for this webinar. The next webinar we look at is webinar 9, Solvency and Sustainability. And in the meantime, I'd be delighted to take any queries or comments. Please contact any of the representatives of the Curtin Not-for-Profit Initiative available on this screen, and I look forward to discussing any ideas for further content, any questions or any comments that you might have. All the best, and talk to you soon.